Armanino McKenna, and I welcome you to today's webinar on stock option plans and taxes for individuals and corporations. So thank you for joining us. The first thing we will do this morning is explain how to use your webinar pane. You'll see the webinar pane in front of you. Please note that the orange arrow will allow you to minimize or maximize the pane. If it is minimized, simply click on the orange arrow to bring it back. Feel free to submit any questions that you have for our presenters throughout the duration of the webinar. Our presenters will handle the questions at the end of the webinar as time permits. And all webinar participants will receive an email in the next 48 hours with a link for a copy of the slides and a video of the recorded webinar. Additionally, now is the time to modify your audio settings. If you are using your telephone to listen in on our webinar, please make sure you select Use Telephone. If you're listening through your computer speakers, please select Use Mic and Speakers. If you have the incorrect settings selected, it will produce an echo sound. To qualify for California continuing education, you must use a personal computer, no PDAs, and log in with your own information and unique URL. You must be logged into our online software for at least 50 consecutive minutes within the scheduled time frame of the webinar. You also must actively respond to at least 75% of the polling questions we present today and complete the evaluation survey at the end of the webinar. And now I'd like to introduce our presenters. First is Scott Borgia, a tax partner with Armanino McKenna. He has over 25 years of corporate tax experience, and he's worked within a large multinational corporate tax department as well as a Big Four accounting firm. He specializes in consulting on complex tax and business issues, including income tax, accounting matters, and tax compliance. Our next presenter is Scott Schimberg, Senior Manager here at Armanino McKenna. He has more than 20 years of financial executive operations and consulting experience in both public and private companies and has held positions as Controller, VP of Finance, and Administration. He recently returned to consulting after working as Head of Finance for Tria Beauty and learned firsthand how to address a company's stock compensation audit readiness by managing the initial audit for Tria Beauty all the way through filing an S-1. And our third Scott this morning is a senior consultant, Scott Schwartz, with Armanino. He has worked in the legal and financial industries, and he's worked with public and private companies as well as entrepreneurs. He has extensive equity compensation and valuation services expertise for our clients, and he's also worked in our fraud and valuations departments. So again, our three Scotts today will provide you an overview of this topic. Our learning objectives today are that our participants will recognize different rules for a variety of grants, including ISO, non-qualified, and restricted stock, apply processes required to manage stock options, such as collecting taxes, reporting exercises, deducting expenses, and deferring taxes. And finally, you'll be able to review the impact that stock options have on APIC, deferred taxes, and income tax rates. In our overview today, we're going to cover U.S. individual taxes, U.S. corporate taxes, and income tax accounting, and of course all those subcategories as well. And with that, we are going to give you our first polling question. So please remember to participate in the polling questions by voting. So the first question today is, how do you manage tax risk with your stock option plan today? A, hire a consultant or consulting firm. B, manage the risks internally with your own staff. C, what risks? Do we have issues? So you have your choice there. We've got about 50% of the audience has voted, and we will leave the polling question open for a few more seconds. So please do get your vote in now. All right. So again, it's A, hire a consultant or consulting firm. B, manage the risks internally with your own staff. And C, you're unaware of the issues. So with about 85% of the votes in, we are going to go ahead and close that poll. So thank you for participating. And Scott, would you like to share the answers with the audience?
Yeah, it's actually interesting. There's a few that don't don't understand what risks that we have out there in terms of taxes, both for individuals and corporations. And then about half of it are doing it internally or knowledgeable about the taxes and risks, and then the other half are relying on consultants. And I'd say that's about what we see when we talk to clients. A lot of our clients actually need some help at some point with the levels of complexity, and hopefully we'll be able to go through and demystify some of those topics as we go through and answer those questions, so we can shift that curve a little bit.
Great.
All right. All right, so we'll start off with going through individual taxes and the impacts of taxes on individuals, and we'll talk about the different types of grants that can be done, and then we'll get into the rules around the taxes that come into play, and then some specific types of transactions like a disqualifying disposition. And so just in terms of the overall, in terms of the types of stock options, we have the incentive stock options, the non-qualified stock options, and then the restricted stocks, both the awards and units. And what we're going to find as we go forward and we look at our next couple of slides is that based off the type of grant it is, it's going to have different timing of taxes. So we'll see when the timing comes out of when it gets taxed to the individual will be different, as well as it can impact the tax rates that come out. And so just overall, we have just calling out the ISOs and non-qual grants. And this is, most of this is general knowledge for everyone, but I think it's good to go over. And that is, to be qualified as an ISO, you really have to meet the general requirements of that to qualify as an ISO. And so, the basics are having a 409A valuation, and then having it so that when it vests, they can't have grants that will be exercisable over $100,000 in value in any 1 year. All of the remaining of those would end up being in the non-qualified items. And then the other end of it is really when it gets into the expiring or 3 months after termination. They would need to exercise those grants within that time period. And then as well as being an employee, they need to make sure that comes in. And just to call out in terms of if a grant is done and it's not valued at the appropriate price, what could happen is that grant could then be included in that individual's income, and it could be taxed at vesting versus getting the free ride of the ISO and waiting until they actually sell. And then they could also run into a 20% penalty on that as well. So it's really important to make sure that there's a good 409A valuation, there's a supportable value for the grant at the fair market value. But I think the big thing is when we really start looking at the ISOs and non-quals is we have to be careful of events that will change an ISO to a non-qual. So we already talked about the exercisable over $100,000 of grants in any 1 year. But one of the big things that at least I see our clients running into is the definition of a U.S. employee. And so it's changing from a U.S. employee to a consultant. We see that quite often, but that does trigger a change in terms of whether it's an ISO or non-qual.
Yeah, and on the 3 months after termination, that's a key issue as well. Some companies, some of our clients happen to give longer terms, and once you extend past that 90 days, that becomes a non-qualified option, and the company needs to withhold. There's recently a client of mine ran into this issue, and they caught it at the last moment, and fortunately they were able to withhold from the participant. Otherwise, they would have had a huge tax liability.
Yeah, that's a frequent item. They think it's an ISO and they don't collect the taxes for the non-qual, and that becomes an after the event fact. Usually the employee is long gone, and the corporation winds up having to pay for that down the road.
Yep.
All right, so really getting into the stock options for individuals and the summary and the timing of when do things get taxable. And so, the ISOs, they have very favorable events that it really doesn't become taxable, or the intention is that it doesn't become taxable until at the event of a sale. And if it's a qualified disposition, meaning it meets all of the requirements of an ISO, it would come out as a capital gain. And the big thing is you don't know whether it's a disqualifying disposition until it's actually sold. And so that would be a down-the-road event of trying to track of when does that become a disqualifying disposition. For the non-qualified options, it is taxable at the exercise. And then for RSAs, or for the restricted stocks, it's really taxed at the vesting unless there's an 83B which has been filed. And there's some very, very tight rules around 83B. And that is, the one that is the biggest is really making sure that that's filed within 30 days of the grant, of accepting that RSA grant, so that would qualify. And then an 83B can't be done with the RSU because the stock hasn't actually been transferred over. So an RSU can be given as stock or cash, and that's determined down the road, not at the point of the grant. So the 83B is only for the RSAs. But a little tidbit of information of how do you handle dividends, and dividends. If you filed an 83B with that, it would be treated as dividend income. Otherwise, if you receive dividends, it's treated as ordinary income.
And 83Bs are also possible for ISO non-quals if there's early exercise options. It seems to be somewhat common for older shares, not as much in the last couple of years, but some of the older shares having early exercise, and a participant could also file an 83B for that as well.
All right, so talk a little bit about disqualifying dispositions. And so this is really getting into an ISO of when does it become a disqualifying disposition, or what would happen. And so you have to really think of it as the stock's been exercised and it qualified as an ISO, so you're thinking everything's going along well at that point in time. Certain transfers can trigger it to become a disqualifying disposition. And then if you don't hold it within the required of 2 years after the ISO is granted or 1 year after the ISO is exercised, that would trigger a disqualifying disposition as well. And then there's a couple transfers that are allowed. In a divorce or death are the typical ones that we see the most often. Those would still qualify. And then in terms of calculating out the taxes for a disqualifying disposition and the treatment to the individual, just kind of working through a scenario of if we have a exercise price of $5 and at the date the fair market value is $5 that would come in. It really depends on when it's sold. So you go down the road a little bit, and if it has an increase in value, and say that it went from the 8 to the 12, you'd end up with $3 of ordinary income, which is the spread between the 5 and the $8 at the date of exercise. And then you'd have a capital gain upon the sale of that between the 8 and 12. And then if it declines in value, so we always hope that it goes up in value, but the reality is some of them go down in value as well. If it went down to $6, which is still over the exercise price, you'd have a $1 ordinary income. And then if it goes down even further below your exercise price, you'd have no ordinary income, and you'd have a $1 capital loss that comes through.
So with that decline in value, basically it's the lesser of the spread at exercise or the that value at sale.
Correct.
So another way to put that.
Correct. And then so we see a lot of these on like a same day sale. They won't have